I don't think gold's going to go off to the races until the next printing round starts. It could stop. We could stop the decline here, and we could head steadily higher in a stair-step way, like we did in the end of the last bull market. I think that's what's going to happen. But again, like if you've been buying every month and you've been buying, a certain dollar amount every month for the past, year, does it really make a difference if you got in at 2,800 and then you buy another tranche at 2,550 and then next month it's 2,700? Like, who cares? We've got to stop looking at the dollar price. The dollar price doesn't really matter with gold. It matters with Bitcoin. If Bitcoin doesn't keep going higher, I think people lose interest, but nobody's ever going to lose interest in gold. It doesn't make any sense.
According to Rafi Farber, gold continues to maintain its status as a reliable safe haven asset. Citing a Deutsche Bank report shared by Bloomberg, Farber points out that gold has been the top-performing mainstream asset in the first 25 years of this century. While gold is clearly in a strong uptrend, he notes that many speculators are fixated on the $3,000 per ounce price target. However, he believes the odds of reaching this level by the year's end are dwindling as market fundamentals have shifted. Farber describes the recent correction in gold prices as a typical and insignificant pullback, especially when viewed in the context of long-term trends. Drawing comparisons to the 2009 to 2011 bull run, he advises against panicking over such fluctuations. While Farber acknowledges Bitcoin's growing popularity, he remains critical of its role as money, contrasting its price-dependent appeal with gold's 5,000-year history as a store of value. He emphasizes that gold's enduring stability, particularly in times of crisis, continues to secure its dominance in global financial systems. In contrast, Bitcoin, held in far smaller quantities by central banks, around 2% of its total supply compared to gold's 20%, is still seen as speculative and lacks the same level of confidence. Farber further explains that during financial crises, gold consistently outperforms other assets, including Bitcoin. He highlights Bitcoin's sharp decline in value relative to gold during 2022 as evidence of its instability. Although he entertains the idea that Bitcoin might one day act as a gold derivative, he remains skeptical until proven otherwise in future crises. For more insights, Farber encourages viewers to subscribe and stay tuned for his latest analysis on the evolving financial landscape.
I think it's a pretty good buying opportunity. I looked at the low versus the high. I think it came out 9.3%. 9.3% is a perfectly normal correction. You don't even have to sweat about it. I mean, these things happened during the 2009 to 2011 major bull run at the end of the gold bull market in those 2 years. And, we barely see those on a map anymore. So what are we sweating about a 9.3% correction? It's a little bit more frustrating when Bitcoin reaches like 95,000 or whatever it's at. And that's great. I mean, I hope Bitcoin is money. I don't think it is. And I'm happy if you're a liberty-minded person who has a lot of money now. That's great. Just be careful with it and lock some of it away into an asset that has 5,000 years of history instead of just like 15. That's what I would do. So is this the bottom? We don't know. I don't think gold's going to go off to the races until the next printing round starts. It could stop. We could stop the decline here, and we could head steadily higher in a stair-step way, like we did in the end of the last bull market. I think that's what's going to happen. But again, like if you've been buying every month and you've been buying a certain dollar amount every month for the past year, does it really make a difference if you got in at 2,800 and then you buy another tranche at 2,550 and then next month it's 2,700? Like, who cares? We've got to stop looking at the dollar price. The dollar price doesn't really matter with gold. It matters with Bitcoin. If Bitcoin doesn't keep going higher, I think people lose interest, but nobody's ever going to lose interest in gold. It doesn't make any sense. I said, when am I going to be wrong about Bitcoin? When we see the next financial crisis, the next monetary crunch in the bond market collapsing, and what I said about the repos and running out of dollars and the money markets freezing up just like it did in 2020 and 2008. If that happens again, it's going to happen again. When that happens again, if Bitcoin can maintain its price in gold terms, not in dollar terms, I don't care about the dollar terms, but if the Bitcoin to gold ratio can stay stable during that sort of crisis, then I'd say, okay, fine. Bitcoin, I wouldn't say it's money, but I would say it's a viable money derivative. Okay, because when those things
Ponzi
happen. When you
scheme,
have a monetary
where firms
crisis,
rely
it looks
heavily
like
on
gold's going
increasing
down,
leverage.
but it's not.
Farber
Gold always
predicts that
goes
a
up
collapse
during
could
those
occur when
crises
the
in terms
repo
of other
market runs
commodities,
out of
in terms
available
of stocks, in
dollars,
terms of everything else
forcing the
except for
Federal
dollars, because
Reserve to
dollars is
engage
chief
in massive
gold
money
derivative,
printing.
right? But in a financial
He
crisis, if you're a
highlights the
real money,
immense
you're going to
scale
go
of the
up, not
U.S.
down.
Treasury
So if
market,
I'm not even saying that
which
Bitcoin has to go
handles
up in gold terms, I'm saying it just
approximately
let stay
$900
relatively
billion in
stable. It did not in
transactions daily,
2022, not even
with
close. It went from
high-volume days
37.5
reaching up
ounces to
to
10. This time I think it's
$1.5
going to be even
trillion.
worse. But if it's
The
not,
repo
then,
market,
you know,
a
at
crucial
the end of the
mechanism for
crisis, maybe I'll buy some
financing,
Bitcoin.
processes around $4 trillion
Because if
each
it's a
day.
viable gold
Farber
derivative, I'm
points
not going
to
to get rid of
U.S.
my gold. I'm not
Treasury
going to sell it.
futures,
But yeah,
which
I'll
saw an
have some
average daily trading
blockchain
volume
gold
of about
stuff. I don't see things. I don't see that happening, because if you want blockchain gold, there is blockchain gold. Just buy that. Why Bitcoin? I don't. Yeah, I could be wrong, but I can't see how it's a viable gold derivative. It might be, and they would have to prove it empirically, even though I can't figure out logically how it would work.
Funding pressures Rafi Farber warns of an impending financial crisis that stemming from historical short positions in the U.S. Treasury market could be even more aggressive than during the 2020 situation to a Ponzi scheme, money printing, where firms rely heavily on the repo to reserve ratio is Farber predicts that a collapse could occur when the repo market runs out of available dollars, significantly weaken the Federal Reserve to engage in massive money printing. This escalating leverage is creating a cycle reminiscent of a Ponzi U.S. Treasury market. He explains that firms depend on the repo market $900 billion in transactions, but are increasingly stuck in positions that require more borrowed dollars to sustain. $1.5 trillion. When the supply of new dollars dries up, a crucial mechanism for financing, compelling the Fed to intervene. $4 trillion each day. In such a scenario, Farber points to U.S. Treasury gold to rally, which saw an average daily trading volume of about $750 he remains uncertain about its role during the crisis, as a focal point where pressures are gold's historical reliability is likely to prevail. Traders have leaned heavily into basis swaps involving secured and unsecured overnight U.S. dollar rates as funding pressures ripple through repo markets. Farber suggests that based on historical patterns, the Fed's response this time could be even more aggressive than during the 2020 crisis, with faster money printing. He also warns that the repo to reserve ratio is nearing levels reminiscent of the 2019 crisis, which could significantly weaken the U.S. dollar. Farber believes this escalating leverage is creating a cycle reminiscent of a Ponzi scheme. He explains that firms depend on the repo market to fund leverage trades, but are increasingly stuck in positions that require more borrowed dollars to sustain. When the supply of new dollars dries up, the repo market could freeze, compelling the Fed to intervene. In such a scenario, Farber expects gold to rally as investors flock to it as a safe haven. As for Bitcoin, he remains uncertain about its role during the crisis, emphasizing that gold's historical reliability is likely to prevail.
I think this is going to be the proximate trigger of the next financial crisis. I could be wrong, but the direction that I see it going in, it's heading in a single direction very, very quickly. What I'm seeing is, for example, if you take a look at the open short positions on the 5-year and the 2-year Treasury notes, they keep getting more and more extreme week by week by week. If you look at the COT reports, the commitment of traders reports, and to open short positions, you need dollars, right? And for dollars, in order to make any money on these trades, you need to multiply them over and over and over again. So you need to borrow a lot of money, a lot of leverage. That's how leverage works, right? The firms that do these trades get leverage through the repo market, and the repo market is running out of dollars. And when it does, you have all these firms, hedge funds, whatever they are, that are opening these trades every day and recycling them with borrowed money. They're also stuck in them. They can't get out, right? They see a winning trade, they keep multiplying it, and then it's like when you start a Ponzi scheme, and then the first people need to redeem, you need to go more into getting more clients in order to pay them back, and then you make more money eventually. But you need to keep growing at the same Ponzi principle. So that's what's happening with these basis trades. Like, people on the other side want to close, and they have to open more, and it keeps getting bigger and bigger until you're out. Instead of new clients here, you're talking about new dollars, and the new dollars are running out. When they run out, all the trades are going to have to close at the same time, and unless the Fed says, "Oh, here's more dollars." How are they going to do that? They're going to buy bonds like they always do. Since the short positions are so massive, the amount of dollar printing is going to have to be a lot more extreme than it was even in 2020. And it's going to have to be a lot. It might even happen before Trump gets into office. We're at about a 74% ratio ratio of total bank reserves, of repos to total bank reserves. Like how much of this money is being used for repos? It's about 74%. So last time we had a repocalypse, as it was called in 2019, the ratio was about 83, 85%. So we're almost there. We might not get there by January. We might get there by January, but it's going in one direction. It zigzags up and down. Eventually it's going to reach it. When it does, the Fed's going to have to print. And when it does, the dollar's going to fall.